Can you hear me, Dion?
Yes, I can.
Okay, perfect. Let me just wait. Okay, it's 12 now. Good day, students. Thanks for joining our session today. To introduce myself for those who are attending the first time, I'm Siyanda Mkati. I'm the module representative leader for FAC 1502. Today, what we are doing, we are having a facet online class. We are addressing adjustments. So I will not just waste time today because I have a load shedding exactly at 2 and this session is allocated for only 2 hours. So we'll just go straight to the work for today. And if there are questions, write it on the Q&A session. I have colleagues here who will assist in terms of addressing your question as we proceed with the session. So let me just move straight to so just a quick one adjustment. We are dealing with learning unit number 6 on your lessons. So most of the examples that we're gonna use here are actually appearing on learning unit number 6. Let me then move to the next slide. I'm not sure why my slides are not moving. Let me just check quickly. Okay, perfect. So the purpose of this lecture is to learn about adjustments and to understand when do we perform adjustment. I'll also show you the process of recording transactions in the accounting books, because most of the time students get confused when we do adjustment, which transactions have already been recorded and which transactions are still outstanding. Remember on our previous, on learning unit number 5, we've addressed the issue of when do we record transactions in those subsidiary journals. Remember what we said there is that we record transactions in those subsidiary journals on the day the transaction took place. So we record it daily. If someone comes and pay, if one of your debtors come and pay, you will record it in your subsidiary journals. Or if you make a payment on that particular day, you will also record that transaction. So it's very, very important to understand this process so that when we start doing adjustment, we are clear why do we do adjustment. And number 3, we're also going to learn why do we perform adjustments. And we're just going to touch base on the trial balances that are prepared at year end. And we're also going to look at the types of year-end adjustments that we have specifically for this module. You will notice maybe we'll leave 1 or 2 out, but I will explain why did we exclude those ones. And then we're just going to do a short class exercise regarding year-end adjustments. This exercise is revision exercise 6.5. Maybe you'll have seen on my announcement that I posted when I was announcing this class, I did indicate that we will be doing a revision exercise 6.5. But I did make some few changes on the requirements on what is required so that we make sure that we address adjustment only, nothing else in those questions. But you will see as we proceed. What is adjustment and when do we perform adjustment? As you can see from the slides, we are saying that adjustments are performed at the end of the financial period if the purpose is to prepare financial statement at the end of the year. So here, let's assume that maybe you wanted to, maybe in that particular entity or business, they wanted to do an interim financial to prepare interim financial statement. They were gonna do what? They will also have to perform what? Adjustment. But for the purpose of this module, our key focus is that we're gonna do the adjustment at the end of the year for the purpose of preparing financial statement at the end of the year. So before I move, when we do adjustments in accounting, we need to understand that we don't do adjustment because there is just something that we have identified as maybe incorrect or there was an error. So if in accounting, if there is an error or there was maybe some omission, when we discover that, we will correct it immediately when we discover it. But these adjustments that we are talking about here, that we're going to perform at the end of the year, it's because we are trying to comply with the accrual basis that we are following in accounting. I'll explain it as we proceed. What is accrual basis? What are we trying to do here? So if you look now in the process of recording transaction in the accounting books, as I have already indicated, that we record accounting transactions on the day it takes place in the accounting books. So if the business decide to make a payment to a particular supplier on that day, we have to record it in the accounting books. But you can see already by applying that principle of saying we record accounting transaction on the day they take place, it's already assuming that so what you can assume right now is that when you make a payment, so there is cash leaving out the business, you want to record that particular transaction. It seems like we are following a cash basis in terms of recording if you follow this principle. But in accounting, we know that we are required to use the accrual basis. I will show you as we proceed. And again, this principle is also assuming that all the transactions that have been recorded in the accounting books were in respect of that specific financial period, which is not the case. Someone can actually come to your business and pay maybe if it's rent, pay the rent for the next 15 months. We know exactly that the financial period has only 12 months. So which means if they pay for 15 months, they've also paid for 3 extra months that don't belong into this current financial period. So that's what this principle is assuming. That's why then there is a need for us at the end of the year to do what? To do adjustment. Because when we do adjustment, what we are trying to do there is to say we are taking out all the transactions or income and expenses that do not belong into the current financial period, so that we don't overstate or understate our income and expenses for this particular period. Here, the timeline that you see here, I'm just showing you that the current financial period, if a current financial period ends on 28 February 20.1, we know that financial period has how many months? 12 months. So in accounting, it's very important when we give you information and we tell you that the financial period of that particular entity or business, it ends on this particular date and a year, you need to be able to understand and determine what is the starting period. When did it start? Here we are told that it's ending on the 28 February 20.1. So what does it mean? It means that when in 1 March 20.0. So you need to have 12 months. So you will just have to work backwards. So here, this February should be 20.1. That's an error. That it should be 20.1 because this is the end of the current financial period, and you calculate the months going backward. We know if you calculate going backward the 12 month, you will have to start when? On March 20.0, which is the previous year. It is very important when you do adjustment that you draw out the timeline, determine when does the financial period start and when does it end. We know that the financial period has how many months? 12 months. Because it's very important to do adjustment. Some of the adjustments might be made, the payment might be made during the year for the next 12 months. So you need to know when to start calculating. So moving on, as you can see here is that there is that possibility. Because if you follow the principle that says record accounting transaction on the day it took place, there is a possibility that there could be transaction recorded in the current financial period ending 28 February 20.1 that do not belong into the current financial period. So then what do we need to do if we assume that there is this kind of possibility? Then what we need to do, how then do we correct this assumption? We need to remove the transaction that do not belong into the current financial period. This can only be done when at the year end. That's why we have to perform a year-end adjustment. Remember, when we do year-end adjustment, there are no errors. That's not an error. That's not an omission. It's what we are trying to do now. We're trying to account for transactions of income and expenses that belong into the current financial period, and anything that falls outside it need to be taken out. I will show you as we proceed how we do that. So as I've indicated earlier, that if you follow that principle that says record transaction when they take place, it's already assuming that you are on a cash basis, but in accounting we are using what? The accrual basis. So now to convert from that to the accrual basis, what does accrual basis require us to do? Accrual basis, for example, on income, it says you need to record transactions of income in the financial period when income is earned, not only when cash is received. Let's make a simple example. If someone comes to your business and maybe you are renting a space, they pay rent income for 15 months. Let's say it's 15,000 rent. What you will have done then, on the day you received that money, you will have said, you will have recorded that amount where in your cash receipt journal, because we recorded the transaction on the day it took place, where in our subsidiary journals. And if we are receiving money, we're recording where in your cash receipt journal. You will have recorded the entire 15,000 rent for the rent. So let's assume that this rent income was paid at the beginning of the current year. So you will notice that accrual basis now, it's saying it's demanding us to say record the transaction of income in the financial period when income is earned, not only when cash is received. Then we need to ask ourselves then to say, did we earn this 15,000 rand for 15 months? The answer to that will be saying we will have earned how much? Only 12,000 rand, because 12 months fall into the current financial period. And what about the 3,000 rand that we've also received? Have we earned that amount? No, we have not earned it, because we haven't provided maybe the space for that customer to rent and utilize that. So they haven't utilized that. We haven't earned that 3,000 rent. So this is where this accrual basis, now we're trying to correct that principle of saying record transaction on the day they took place. But now for us to record that, what do we need is to say, have we earned that income? So now you will see that when we record income and expenses, they have to relate only to that financial period that we are dealing with. Let us move. So here, maybe just to highlight that, two important questions that we can ask here. What about all types of income, such as your interest income, rent income, commission income that has been earned in the financial period, but no cash has been received yet? There is another possibility where, let's say, for example, that we know that the rent per month is 1,000 rand. But and the person started renting our space from the beginning of the year. And when we check our trial balance, we can see that only maybe 10,000 rand of rent income we have received. There is still that 2,000 rand that is outstanding, although we have provided a space to that customer. And so they have used the space, but they haven't paid us. What does accrual basis requires us to do? It says, please also recognize that income of 2,000 rand. Why? Because you have earned it. You have provided the customer with a space to stay in, and they stayed. So which means we also need, for us to have a complete rent income for the year of 12,000 rand, we need to say 10,000 that has been received, which was cash, plus the 2,000 that is outstanding. That's what this principle of accrual basis requires. It says record transaction of income in the financial period when income is earned. That is key, that we need to know that we have earned it or not. So we've already addressed this part. What about the types of income that has been received in advance in the financial period? Such as rent income, but yet not earned. We know that if we have received money like your rent income that we have not yet earned, because we have not yet delivered what is expected out of us as a business, that income needs to be taken out from the rent income so that we don't overstate our rent income that we have received. The same goes with your expenses. Accrual basis requires us to record transactions of expenses in the financial period when expenses are incurred, not only when we make payment. So to incur an expense, for example, let's make an example of water and electricity. If you have used water and electricity in your business for the whole year, maybe you haven't paid for that water and electricity, you have incurred that cost. You have made use of that water and electricity. So now the only thing that is outstanding is for you to pay. So the cost has been incurred. There is no other way of reversing back the water and electricity that you have used. So that expense has been incurred. So what accrual basis demand out of us, then it says record the transaction of expenses in the financial period when expenses are incurred. If you incur that water and electricity in the financial period, please record that, even if you haven't made the payment for that expense. And it also says, so let's say, for example, sometimes it happens that the business maybe decide to pay for insurance. They pay in advance, maybe they pay for 2 years. So if they pay for 2 years, already you know that they are paying for the insurance. Let's assume that when they were paying for this insurance, to say maybe they paid 24,000 rand. So we know that a year they are paying for 2 years, which means 24 months. So it's 1,000 rand per year, per month. So we know that the portion that will belong to the current financial period, it will only be 12,000 for those 12 months. And the one that is falling outside to the next year, the question we need to ask ourselves, have we incurred that insurance expense? We have not. So which means that's still our money. We can still go to that insurer and demand that money for that we've paid for the next 12 months. So which means that insurance expense that we have paid for the next 12 months, it should be done what we should deduct it, and so we should deduct it from the current insurance expense so that we don't overstate the insurance expenses that we have. So it's very important for us to understand how the accrual basis works. Simple, just to wrap off this one, is to say accrual basis says record transactions of income in the financial period when income is earned. So how do we earn income? It means we have delivered as a business everything that we needed to deliver to the customer. We are just waiting for payment. If we needed to deliver the good to the customer, goods have been transferred to the customer, which means we have earned that income, although we haven't received the payment. And expenses, accrual basis say record transaction of expenses in the financial period when expenses are incurred. I've already explained what does it mean to incur an expense. So when we apply, so another part that I need to explain here when we deal with the accrual basis method is that accrual basis method, it follows what? A matching principle. So what does a matching principle require? It requires that revenues with their related expenses be reported in the same financial period. If you look below here, I will be making an example here of an entity with a financial period ending when? 28 February 20.8. Let's assume the entity generated revenues amounting to 100,000 in the current financial period and decided to provide employees with a performance bonus of 5,000 rand, but the bonuses will only be paid on 31st March 20.8. You will notice that we said the current financial period ends when? It ends on 28 February 20.8. So which means the next financial period starts when? It's going to start on 1 March 20.8. But they are telling you here that the bonuses will only be paid on 31st March 20.8, which means the bonuses will be paid in the next financial period. Below on this table, I'm showing you that if we don't apply the matching principle that is followed by the accrual basis, what will happen? And if we apply the matching principle, what happens? So let's start with without applying the matching principle. So we have 28 February 20.8, which is our current financial year. How much revenue did this entity make? It's 100,000. Let's say we don't apply what? The matching principle, because matching principle requires that the revenues with their related expenses be reported in the same financial period. So if we don't apply that, bonus expenses will record 0. And at the end of the current financial period, we're gonna have what? A profit of 100,000. This is when you don't apply the matching principles. And what will happen in the following year then? In the following year, we'll have 0 revenues, and we'll be recording what? A bonus expense of 5,000, because they told you that it was going to be paid when? On 31st March 20.8, which falls within the next financial period that ends when? On 28 February 20.9. So you will see then in that year we'll have what? A loss. So you can see that what the matching principle is trying to do here is trying to avoid overstating your profit in one year and overstating your expenses in the following year. Because now in 20.8, you'll be reporting a profit of 100,000, and in 20.9, you'll be reporting 5,000 of expenses, which is your bonus that you have paid to your employees. But now, because we know that without applying the matching principle, we end up with overstating or understating our expenses in that particular year. Then we have to apply the matching principle. What happens when we apply the matching principles? Let me go back again. Matching principle requires that revenue with their related expenses be reported in the same financial period. So you're gonna say in the current financial period, we have what? A revenue of 100,000. Then under bonus expenses, we're gonna report what? 5,000 rand, which is our performance bonus. Although that the bonus is gonna be paid in the next financial period, when did we incur as a business this expense? The employees managed to, we were happy with their performance in the current financial period. So which means the expense was incurred when? In the current financial period, and it needs to be recorded when? In the current financial period, even if the payment will only be made in the next financial period. When you apply the matching principle, there is no understatement or overstatement of profit or losses. Now we see that we end up with 95,000 rand. That's why we emphasizing here that the accrual basis, it follows what? The matching principle. So it means it requires that the revenues with their related expenses be reported in the same financial period. So just to summarize, why do we do adjustment then? To ensure that all current financial period accounts have the correct balances before final accounts and financial statement can be prepared. Because if you don't do adjustment, chances is that your balances in the final accounts and your financial statement will be having incomplete information. So which makes those balances to be incorrect. So it is necessary for us to do what? Adjustment first. So as we do adjustment, so you will notice that is that all transaction income and expenses that should have been recorded in the current financial period have been recorded. So what we are trying to make sure that when you do adjustment is to ensure that all the income and expenses that should have been recorded in the current financial period have been recorded, even if no income has been received or no expense has been paid in the current financial period. And when we do also the adjustment, what we are also trying to do here is that all the transactions of income and expenses that do not belong into the current financial period, they need to be subtracted from what? From income and expenses, and they will be classified as assets and liabilities. I will show you how they become assets and liabilities. Remember that, guys, when we are dealing with income and expenses, those income and expenses, we record them only for that specific financial period. When we start a new year on the next year, our income and expenses accounts need to be sitting at zeros so that we start afresh. So that's why we are saying here that the income and expenses that do not belong to the current financial period, we subtract them because they don't form part of this current financial period, and we classify them as asset or liabilities. I know it's been a lot of theory talking around, but I will show you as we start to do the examples one by one. Okay. The types of trial balances that we prepare, that are prepared actually at specifically at the end of the year. We've got three trial balances that we have. We're going to have a pre-adjustment trial balance. So it's clear, just saying pre-adjustment trial balance, it's before considering year-end adjustment. So it's before considering the adjustment that we're going to be learning today. That's why it's called pre-adjustment. So when we give you a pre-adjustment trial balance, we also provide you with what? Additional information. So under additional information, then you then have to scrutinize that information to see what has already been recorded and what is still outstanding. So that's why you will have a pre-adjustment trial balance. So, and then you're going to have what? A post-adjustment trial balance. It is after considering what then? Your year-end adjustments. And then we're going to have what? A closing trial balance, which is after considering your closing of journal entries. And on our next session, we will cover the closing of journal entries so that you will see how we process the closing of journal entries. So there's nothing to panic about today. So just know that most of the time when we ask you questions in accounting, maybe we want you to prepare the statement of profit or loss and other comprehensive income or financial position, we always give you what? A pre-adjustment trial balance, because we want to test and see whether you know how to treat adjustments at year end. Yes, so it's very important. So we'll always write it a pre-adjustment or it's an extract from a pre-adjustment trial balance. I just also included this slide. It's there in your learning unit number 6, which explains that for example, at the on top here, it says the trial balance is prepared as many times as required, but at least every month. At the end of the financial year, as many as 3 trial balance can be prepared. Those are the ones that I wanted us to focus on, which is your pre-adjustment trial balance and your post-adjustment trial balance and your post-closing trial balance. You can just go and read, but it's the same thing that I've explained on this previous slide, just to simplify it. Before then we start with our adjustments, I always like to go back to my basic accounting equation. I think all the session that we have, I've always say, let's go back to basic accounting equation. What is our basic accounting equation? I like to call it ITA, basis of reasoning in accounting, which means every transaction that you're going to deal with, you need to see and understand how does it affect the basic accounting equation. I think it becomes much easier for you to know whether you are debiting this or you are crediting that. So basic accounting equation, we say asset equal to owner's equity plus liabilities. But then on this next slide, I just break it down. This will never change. It hasn't changed for so many years. It will always be like this. Asset increases on which side? On the debit side. They reduce on the credit side. Expenses increase on the debit side. They reduce on the credit side. Equity increases on the credit side, reduces on the debit side. Liabilities increases on the credit side, reduces on the debit side. Income increases on the credit side, reduces on the debit side. So it has been like this. So you can already tell that assets and expenses, they behave the same. They increase on the same side, they reduce on the same side. Equity, liabilities, and income, they behave the same. They increase on the credit side and reduce on the debit side. Another thing that we need to understand here is that transactions that affect expenses and income directly affect what? Equity. So for example, here, when you say expenses are increasing on this debit side, what is the impact on equity? It means on the debit side, equity is decreasing. Because when your expenses are going up, it means equity is going down. And when expenses are going down on the credit side, you go to the equity on the credit side, what does it? It means equity is increasing. Then income, if income is decreasing on the debit side, it means also the equity is decreasing. Income, when it's increasing on the credit side, it means also equity is increasing on the credit side. So just take this is that all transactions that affect expenses and income directly affect equity, because when we ask you the effect on basic accounting equation, you'll have seen already on the previous slide. Good, here we talk about asset, owner's equity plus liability. There's no income and expenses. So if you want to show the effect, you know that if it's a transaction that affects income or expenses, it will affect owner's equity. It has always been like that. Nothing has changed. So now we are starting with the types of year-end adjustments that we do. So the first one that we're going to look into is the prepaid expenses. What is a prepaid expense? Prepaid expense refers to an expense which has been paid during the current financial period, but which relates to a future financial period. So we have paid for this expense before we even incurred it. So it relates to what? To the future financial period. So if the business has done that, they've paid maybe for insurance for the next 12 months after year end. It means that is a prepaid expense. They haven't even incurred that expense. What they can do, the business, if they decide to request that money to be sent back to them, they can do that. It is their money. That's why here we call prepaid expense it an asset. This is very important, because when we start asking questions, students will think that prepaid expense is an expense. It's not. Prepaid expense is an asset. If you understand how the prepaid expense arises, we said as a business, we have paid for the insurance maybe for the next 12 months after year end. We haven't even incurred that insurance. So which means that money is still ours. We can go and collect it whenever we want it. That's why we are saying prepaid expenses, it is an asset. Let us just go through this example so that you can see how this prepaid expense works. So here on the 2nd January 20.1, Bakla Dealers paid a new annual insurance premium of 2,400. They paid it when on the 2nd January 20.1. They paid what? An annual insurance premium. Annual, it means a year, it's 12 months. They paid 2,400 for 12 months. And the current financial period ends on 28 February 20.1. Just check the date when they paid and when the current financial period ends. On the 2nd of January 20.1, they paid the annual insurance premium of 2,400, but the current financial year ends when on the 28th February 20.1. So what is required of us here? Indicate in which subsidiary journal of Bakla Dealers will the transaction be recorded on the day the transaction took place. So on the day they made a payment of 2,400, when was it? It was on the 2nd of January 20.1. So now they're asking here in which subsidiary journals. Remember on our previous lesson on learning unit 5, I told you about the subsidiary journals that we have. So when you talk about subsidiary journals, we are talking about the books of first entry. That's where the transaction they first need to be recorded in before they can be posted anywhere else in the general ledger or in any account. They need to be recorded in the subsidiary journal, and we normally call this subsidiary journal what? A books of first entry. So we'll answer that question. For the second question that we need to look into, indicate which accounts to be debited and credited on the day the transaction took place and the amount. C, does the amount paid only relate to the current financial period? We need to answer that question then. The current financial period ends when on the 28th February 20.1. Then we move to say, if no, because remember C is asking, does the amount paid only relate to the current financial period? If your answer is no, please indicate which amount belongs to the current financial period and which amount belongs to the next financial period, which is 28 February 20.2. Then lastly, it's asking you to prepare the adjusting journal entry at the end of the current financial period. So we are answering A now. To answer A, so where are we gonna record this? Remember here it's Bakla Dealers who paid, so it's the business that paid out. So when we make payment out, we record it where? In your cash payment journal. When are we recording that? On the 2nd of January. The details will say insurance. You will say who that, you will name that insurance name, whoever that we were paying. That will be your details here. And how much did we pay? 2,400. And then there's nothing here under wages, and then under sundry account, you will say 2,400. What is it for? It was for insurance premium. Remember that on our previous lesson, you have seen that how does a cash payment journal look like? So there is a bank column, because here, remember that we've paid, so bank will be affected. That's why we have a bank column here of 2,400. And then we go under sundry account, we record that 2,400 and we write it for the insurance premium. So A has been answered then, which we were required to say indicate in which subsidiary journal of Tata Dealers will the transaction be recorded on the day the transaction took place. CPJ, and then we recorded it was 2,400. B, we were required to indicate which account to be debited and credited on the day the transaction took place. Remember, when you make a payment out as a business, our bank is an asset. And I've shown you that asset increases on the debit, they decrease on the credit side. So when we make a payment, which means from our bank account is reducing, so which means we need to credit it. That's why here we are crediting the bank. We write it an asset. On the credit side, we put 2,400. Then what were we paying for? What is it that we are paying for? We're paying for the insurance. Insurance then expense. And we know that expenses increases on the debit side, they reduce on the credit side. So we're gonna debit the insurance expense of how much? Of 2,400, because our expenses are increasing. One thing that students always get confused here with is that when we say when you pay for expenses, they think expenses are decreasing. No, expenses are not decreasing when you pay for them. So actually what you're trying to say here, the correct question would be to say, how much expenses have you incurred in the current financial period? That's what we are trying to adjust for here. So we'll say, I'm going to debit this insurance expense that I've paid for of how much? Of 2,400, which means my expenses have increased by this insurance expense of how much? Of 2,400. It's very important to always remember that when we pay for expenses, expenses aren't decreasing. The correct question we are asking is that how much of the expenses have you incurred in the current financial period? Then let's move to C. The question that does the amount paid only relate to the current financial period, which ends when? 28 February 20.1. So our answer here is that no. Why are we saying no? First thing, that we were told that it was an annual insurance premium of 2,400. So we need to know how much is it per month. So we say 2,400 divided by 12 months. We know it's 200 Rand. It's 200 Rand per month. So two things here I told you earlier is that we need to always draw out the timeline. Let's start with our current financial period. Current financial period starts when? On the 1st of March 20.0 and ends when? On 28 February 20.1. And you were told that the payment was made when? On the 2nd of January 20.1. So which means in the current financial period, only 2 months belong into the current financial period. It is January 20.1 and February 20.1. Then which means out of those 12 months, only 2 months fall into the current financial period and the other 10 months falls outside. So because our next financial period starts when? On 1 March 20.1 and ends when? 28 February 20.2. So we know now that only 400 belongs to the current financial period and the rest of 2,000 Rand belongs to the next financial period. So that's why we said that the answer is no. The amount paid does not only relate to the current financial period. 400 Rand relate to the current and 2,000 Rand relate to the next financial period. So as we've already addressed this. So they are saying, if no, please indicate which amount belong to the current financial period and which one belongs to the next financial period. So current financial period, it's only how much? 400, because it's those 2 months, it's Jan and Feb 20.1. And then the next financial period will be 200 per month times 10 months, which is 2,000 rand. So we know now that out of this 2,400, 2,000 rand, it's a prepaid expense. Why? Because it relates to the future financial period or to the next financial period. It does not relate to the current financial period. So, and then you were required under E to prepare the adjusting journal entry at the end of the current financial period. Remember, when you're recording on CPJ, you recalculate the entire amount, which is how much? 2,400. But now, because you know that after doing your analysis, you know that only 400 belong to the current financial period and 2,000 belong to the next. So what does not belong to the current financial period, it needs to be taken out. The journal entry that we did when we were recording receiving this amount, we said debit the insurance expense of 2,400 and we said credit what? The bank. But now we know that 2,400 does not belong to the current financial period. So it means this insurance expense is overstated by how much? By 2,000 rand. And to correct that, what do we need to do? We need to credit the insurance expense by how much? By 2,000 rand. Yeah, on this E. When we are preparing the adjusting journal entry, we are crediting what now? The insurance expense, because we are trying to reduce it from 2.4 so that we end up left with only 400. So the amount that we need to reduce is by it, how much? It's 2,000 rand. That's why you are crediting the insurance expense. Then what are we going to debit? We're going to debit what? Our prepaid expense, because we said a prepaid expense is an asset. And so it means when we are removing that 2,000 rand from insurance, this 2,000 rand is going to increase our asset, which is called prepaid expenses. And we know assets increase on which side? On the debit side. So that's why we're debiting prepaid expenses, which is an asset, by 2,000 rand. I hope that is clear. That's why I wanted to show you first on the day the transaction took place, how is it you're going to record it? And then when we ask you to do an adjusting journal entry at the end, what are we trying to do now? Because if you were going to take the transaction that we recorded on the day the transaction took place, that's 2,400, and then you subtract this 2,000 on the insurance, you will realize that the insurance expense will be correctly stated now at 400. Then what we also need to do, this I just wanted to show you that how then do we post. Once you understand well these journal entries that we've spoken about here already, it's become so easy for you to post to the general ledger account for the expense and for the prepaid expenses. Here, expenses, we know they increase on the debit side. So the first transaction that we wrote, we said the insurance expense was debited. What did we credit? We credited bank. So which means the insurance expense was debited. We go to the debit side of this general ledger, you post that 2,000 rand, and the description you write here, when you debited the insurance expense, what did we credit on the day the transaction took place? We credited the bank. That's what you're going to write here, 2,400, and for you here, it is your reference. This we recorded were in the CPJ. Then we also went, what we also did at them on E, when we're doing the adjusting journal entry at the end of the year, what did we do here? We said, what we did, we said credit the insurance expense. This is where it's coming from. We said credit the insurance expense. What did you have to debit? The prepaid expenses. So when you go under the insurance expense general ledger, so you need to credit that insurance expense. But when you credit insurance expense, what is it that you debited? You debited the prepaid expense. That's what you're going to write here. General 2,000 rand. And we know now, after putting these two transactions, that the highest side is the debit because it has 2,400. So both sides must have 2,400. So the difference, what is the difference? The difference will be that 400. And this 400, where do we close it off to? profit or loss account. I will tell you on our next session why we are posting it here. But remember that before you prepare financial statement, you need to close off your income and expenses account. And where do we close them off to? We close them off to profit or loss account. That's why on income and expenses, you can't have a balance carried down, because we close it off to this account, profit or loss account. So both sides now are equal. Then if you were required to do your prepaid expenses account in the general ledger, we said debit prepaid expenses account. And what did we credit? The insurance. So you go to the debit side of your prepaid expenses account, you post that 2,000. And what are the details? When you debited prepaid expenses, what did you credit? You credited the insurance expense. This is the general ledger. When is this? At the end of the year, you write that. So then how do you disclose this insurance expense and prepaid expense in a financial statement? We have two statements here. The first one is a statement of profit or loss and other comprehensive income. In the statement, only income and expenses are recorded here. So we know that we had insurance expense. Our insurance expense, initially we paid 2.4, but then that journal entry that we wrote for the adjusting one, where we debited the prepaid expenses of 2,000 Rand and we credited the insurance expense. That's why we are minusing here, because we know that expenses reduces on the credit side. We minus that 2,000, and then our insurance that we're going to report into the statement of profit and loss is how much? It's 400, which is correct. It's only, this is an expense that only relates to the current financial year. So what will happen then when you go to your statement of financial position? Statement of financial position, we are dealing with asset, equity, and liabilities only. Statement of profit and loss, we're dealing with income and expenses only. So that's very important. So now when you go to the statement of financial position, you will see under current asset, we'll have what? Prepaid expenses. We said a prepaid expense is an asset. So it's going to form part of your current asset. Sometimes we call this prepayments instead of saying prepaid expenses. We say these are prepayments. So it means the same thing of how much you write it here. It's 2,000. Then you are done with that. Then what we also, let's move to the second adjustment that we perform. We have what? Accrued expenses. When you talk about accrued expenses, we're referring to expenses that have been incurred in the current financial period, but which are still unpaid at the end of the current financial period. So we are still owing that expense. We have incurred it, yes. We have used maybe water and electricity, but we haven't paid for it. It gives rise to what? To an accrued expense. We owe that. We owe that water and electricity. We owe that expense to that whoever supplied us with that water and electricity. So an accrued expense, it is a liability. So liabilities, remember, it's what we owe as a business. That's a liability, that's what we owe. So accrued expenses, it is a liability. It's very important. And we know liabilities increases on which side? On the credit side, they reduce on the debit side. I don't want you to get confused with this term. When you say accrued expense, we're talking about a liability. It's very important, because when you ask questions, that's where most students get confused. So we have an example here. These examples are there in your learning unit number 6. I just took them as they are. So on 28 February 20.1, the end of the financial year, Butler Dealers Water and Electricity account shows expenses of 2,880. On a closer examination, Butler Dealers accountant establishes that the February water and electricity account of 360 has not been taken into account. We have, so out of that 2,808, we have not considered this 364 February, so it's still outstanding. What is required out of us here? Which account will be debited and credited for water and electricity that has not been taken into account for the month of February? So here we are just asking the year-end adjustment journal that you need to process. So it is still outstanding. So we haven't recorded that water and electricity expense. So we need to increase our expenses, and we know expenses increase on which side? On the debit side. Already, once you know that water and electricity need to be increased, so you're going to debit water and electricity expense, what are you going to credit then? Because we still owe it, we are crediting what? Our accrued expense. B, then here it says disclose that water and electricity expense and accrued expense in the financial statement. So I will show you how does that one work. So to answer A, what are we going to debit? We're going to debit water and electricity expense. Expenses increases on what? On the debit side. And then what are we going to credit? You're going to credit what? Your accrued expense. Accrued expense is a liability. We owe that. So which means we need to increase our liabilities because we haven't paid for this 360. So liabilities increases on which side? On the credit side. Maybe before we move to requirement number B, that where we needed to disclose this into the financial statement, I want us to, if you were required to post that journal entry now into the general ledger account for water and electricity and your accrued expenses. So we have this water and electricity account. Already you were told here that at the end of the financial year, Caterpillar's water and electricity account shows the expenses of 2,808 because it's an expense, so it will be showing on which side? On the debit side. That's why here we have this balance that has been brought down of how much? Of 2,880. It is already sitting there because that's what they told you, that water and electricity currently shows how much? 2,880. So, and then you were told here that this 306 has not yet been taken into consideration, so we need to add it because we said debit water and electricity expense. So we need to add that 360 to what? So we're going to go to the debit side of water and electricity expense. We put that 360. When we debited water and electricity expense, what did we credit? We credited accrued expense. That's what we're going to write under our details. So if you add these two, 2,880 plus 360, you get 3,240. So which means the debit side is greater than the credit side. So we need to have 3,240 on both sides. So you transfer this to this side here, and then, so which means we need to have here up 3,240. But where are we taking this 3,242 to your profit or loss account? As I've indicated earlier, that expenses, we close them, income and expenses, we close them off to profit or loss account, so that in this account of water and electricity, we don't have any balance to be brought down. There's nothing. Once you have transferred this to your profit or loss account, will be left. This account will be left with nothing. Then below we have what? Your accrued expense. Remember, we said an accrued expense is a liability, and we have credited our accrued expense. So which means we need to go to the credit side of the accrued expense. We put that 360. What details are we going to write here? What is it that we debited when we credited accrued expense? We debited water and electricity expense of 360. We leave it like that at this stage. Then to answer B, sorry, here it's still writing A, this is B. Under B, we were required to do what? To disclose the water and electricity expense and accrued expense in the financial statement for the year ended 28 February 20.1. So we have the statement of profit or loss first. Remember, we said statement of profit or loss. What do we record here? Income and expenses only, but we are dealing with water and electricity expense. So what we're going to do here, we're going to say 2,880 plus 360. It gives us 3,240. It's giving us the same amount that we disclosed here as to the profit or loss account. Why are we adding this 360? Because we said this water and electricity was not taken into account, but it needs to be taken into account so that it increases our expenses. That's why you are adding here. The common mistake, student, that they always make, someone else would have just deducted it. That would have been wrong. It means you did not understand this journal entry, because we said here, when you debit water and electricity, since it's an expense, expenses are increasing. So which means when you come here, you have to add that 360 so that we end up with 3,240. So which means the water and electricity for the whole year has been recorded and reported there. Then let's move to statement of financial position. Here we're going to write under current liabilities. Remember, we said accrued expense is a liability. So which means we need to record that accrued expense. Accrued expenses will be part of what? Of your trade and other payables. We include that 360 of accrued expenses. So at least now we see how these things come about. Let's then move to consumable inventory on hand. Here we are talking about the goods that are consumed in the normal business activities. For example, in a business, they will buy stationery that they're going to use in the office. So which means it's going to be used. They are not selling that. They're just going to use it in the office. The packaging material, they are not selling the packaging material, but they will package whatever product that they are selling. Even the cleaning material that they use for the office or in their building, that will be your, these are goods that are consumed in the normal business activities. They are not selling them. But here, what we are dealing with, we are focusing now on consumable inventory on hand. We are concerned about the ones that are on hand that were not used at the end of the year, by the end of the year. So when we talk about consumable inventory on hand, we are talking about it is an asset for the business. And we know assets increase on which side? On the debit side, they reduce on the credit side. Let's take an example here. On 28 February 20.1, the end of its financial year, Batsadila's stationery account shows that stationery to a value of 500 was purchased during the year. At a physical count, it is determined that stationery worth 150 is still on hand. So I think you can already see that a stationery of worth 150 was still on hand. It was not used. So it becomes what? It becomes our consumable inventory on hand. It is how much? 150. What is required out of us here? At the end of the year, they are requiring us to indicate which account will be debited and credited for consumable inventory on hand on the 28th February 20.1. And number two, you have to disclose the stationery expense and the consumable inventory on hand. That accrued is incorrect there. It should be saying disclose the stationery expense and consumable inventory on hand in the financial statement for the year ended 28 February 20.1. So let me show you then. To record that, firstly, maybe what I should have shown you here first. When they purchased, let's go back here. When they purchased stationery to a value of 500 during the year, what account were they going to debit and credit on the day the transaction took place? So they were going to debit what? The stationery. Stationery is an expense. Expense is increased on which side? On the debit side. They will have recorded debit 500. And what were they going to credit? Because they've paid for that stationery, they were going to credit what? Bank. Bank is an asset, and we know asset decreases on which side? On the credit side. So you'll have debited stationery expense and credited what? Your bank. But now, at the end of the year, they are telling you that during the physical count, it was determined that the stationery worth 150 was still on hand, which means it was not used. So what do we need then to do here? Because initially we debited the stationery expense, we credited bank, but now we know that it was 150 of the stationery was never used. So which means we need now to credit the stationery expense so that we reduce that 500 by how much? By 150. So we are crediting the stationery expense. But what are we going to debit? We are going to debit what? The consumable inventory on hand, which is our stationery. That's an asset. So we're saying consumable inventory on hand. It is an asset. So for example, if we are saying there's stationery or cleaning material or packaging material that is on hand at the end of the year, it immediately becomes what? Our asset. That's why you're going to debit that. So which means our assets are increasing by 150. So you will notice that after reducing the stationery expense from 500 by 150, you'll be left with 350 of the stationery for the current financial period. That's why in your statement of profit and loss, we are recording those expenses that we have incurred during the current financial period. And for stationery, for your consumables, such as your stationery, packaging, and cleaning material, when we report them into the statement of profit and loss, we are concerned about the stationery, the packaging, and the cleaning material that we have consumed during the financial period. So the one that we have consumed, it's only 350 because we know now that 150 was never used. Again, if they wanted you to post to the general ledger account for stationery and consumables, inventory on hand, this is what we will have done. You'll have known that the stationery is an expense. So they tell you that it will have been 500. That is the balance brought down because that's what we've purchased during the year. We'll have just put it here as 500. We could have even written here as bank because we've paid for it. We debited stationery expense, we credit bank, you put 500, you write bank there. And then on the previous journal entry that we wrote here, we said credit stationery. So which means we need to go to the credit side of a stationery and put that 150. When we credit the stationery, what did we debit? We debit consumable inventory on hand. So you will see here stationery, you go to the credit side, you put 150, and under details, you say consumable inventory on hand because that's what we debited. You will notice then that the debit side is more than the credit side because debit side we have 500, but on the credit side we only had this 150. So we need to have also 500 here. The difference between 500 and 150, it is 350, which we close it off to profit or loss account because I said income and expenses are closed off to a profit or loss account. Then under consumable inventory, we said consumable inventory, it is an asset. And on our previous journal entry, you'll have seen that we said debit consumable inventory on hand, which is an asset. And then what did we credit? We credited the stationery. So you go to the debit side of consumable inventory on hand, you put that 150 and you write the description here. It was when we debited inventory on hand, we credited what? The stationery expense. That's why we are putting it here. Then you were required to disclose the stationery expense and consumable inventory on hand in the financial statement for the year ended 28 February 20.1. So here under statement of profit and loss, we have a stationery expense. Stationery expense, we bought how much? 500. Then we have to minus this one of 150. Because the one that is still on hand, it was never consumed. We've never used it in the current financial period. That's why we have to deduct it. You can't add. If you add, it's going to be incorrect. Because we only bought stationery for 500 and we are subtracting the one that we did not use so that we can help, so that we can determine the one that we've used in the current financial period, which is 350. Then under the statement of financial position, we're gonna go under what? Under current asset. So under what? We're gonna include it as an item of inventories. So the consumable inventory on hand, it's gonna be part of your inventories. That's why we're gonna add that to inventories. We add what? That 150. Then let's move to the income received in advance. I hope I'll make it income received in advance. Sorry guys about the numbering here. I was preparing this slide in a rush. So let's just say income received in advance. Income received in advance, it refers to income which has been received during the financial period, but it relates to a future financial period. So as a business, we've received this money that we have not yet earned. So which means whoever paid this money, they can still come back and say, oh, I want my money back. And we'll have to pay them. That's why we're saying income received in advance, it's a liability for the business. We owe that person who gave us that income that we have not yet earned. So it's very important to know that income received in advance, it's a liability. Let's go straight to an example then that we have here. On 28 February 20.1, the end of its financial year, Tata Dealer's rental income account shows that 10,400 was received. So who received the money? It's the business. We've received 10,400. Tata Dealer's rent out a part of each building for 800 a month. On a closer investigation, it is established that the rental for March 20.1 has already been received. Remember, our current financial year ends when? On 28 February 20.1. But they are telling you here that on a closer investigation, it was established that the rental for March for 20.1 falls where? On the next financial period, not in the current financial period, because our current financial period ends when? On 28 February 20.1. So when you talk about March 20.1, you're talking about the next financial period. What is required out of us here? Calculate the number of months the rent was paid for. Already we know. So it's going to be clear. We have received 10,400. They told us that it's 800 Rand per month. We can easily calculate that. B, which account will be debited and credited for rent income that does not belong into the current financial period ending 28 February 20.1. They also want to do what? To disclose the rental income and income received in advance in the financial statement for the year ended 28 February 20.1. So to answer A, we said calculate the number of months the rent was paid for. We have received, as Butler dealers, we have received 10,400, and we know that per month we should be receiving how much? 800. So if you say 10,400 divided by 800, we get 13 months. And we were already told that upon on a closer investigation, it was discovered that we have already received rent for March 20.1. So which makes the 13 months, because we know a financial period, it has only what? 12 months. So the current financial period is just a repetition here. Current financial period started when? On 1 March 20.0, and it ends when? On 28 February 20.1. And the next financial period will start in 1 March 20.1, and it will end in February. It should be February 20.2. Yes, here it should be 20.2. Here it should be 20.2 here. So, but for the current financial period, it starts when? March 20.0 up to February 20.1. You can already see that if you allocate 800 per month here for these 12 months, 12 months belongs to the current, and only March 20.1, which is 800, that belongs to the next financial period. So what journal entry are we going to process there? Maybe before we get into this one, I just want to show you that when Tlala dealers received this 10,400, the journal entry that they wrote, because they've received the money, they recorded in your cash receipt journal. So if you were to do the journal entries, what were you going to debit and credit? When you receive money as a business, it's coming inside the business, which means the bank is increasing, and we know that a bank is an asset. Asset increases on which side? On the debit side. So which means you'll have debited bank and you'll have credited what? Rent income. Income increase on the credit side. So we'll have said debit bank, credit rent income, 10,400, 10,400. Then here, what they're requiring here is that do the adjustment journal entry at the end of the year. What are you going to debit and credit? Because now we are aware that 800 Rand does not belong to the current financial period. Remember that we have already debited bank by 10,400. We credited rent income by 10,400. Now we need to adjust that rent income because we know there's 800 that does not belong to the current financial period. So what we're going to do, we're going to debit the rent income. When you debit income, what happens to the income account? It reduces on the debit side. So we need to debit the rent income by 800. What are we going to credit then? We're going to credit income received in advance, which is a liability because we owe that person who paid us that 800. So liabilities, we know they increase on the credit side. So what will happen here if they asked you to prepare the general ledger account? Preparing a general ledger account becomes very easy when you know what to debit and what to credit, because we've been told already on the rent income. Rent income, it increases on which side? On the credit side, it reduces on the debit side. So we're told that we have received already how much? 10,400. On the credit side, we write that 10,400. Then the second journal and adjusting journal entry that we did at year end, we said debit the rent income, then because we need to reduce that 10,400 by that 800 that does not belong to the current financial period. So what we did, we said debit the rent income, credit what? Income received in advance. That's why you're gonna come here on the debit side. You say you include that 800 rent income, so it's debited by 800. When we debited the rent income, what did we credit? We credited income received in advance. That's what you write here. Then we know that this side, the credit side, is greater than the debit side, because on the debit side we only included this 800 so far. So we need to make both sides to be 10,400. So when you look now, that's only here we have 800. If you say 10,400 less, that's 800, you will be left with 9,600, so that it balances. Both sides will be equal. So we have this what? 9,600. What details do we write here? It's a profit or loss. I've indicated earlier that income and expenses are closed off to where? To your profit or loss account, so that we don't have any balance carried down here. So this account is sitting at 0 now. It's finished. There's nothing else here. Then income received in advance, we said it's a liability. Liabilities increase on which side? On the credit side. You saw the journal entry that we wrote. We said debit the rent income, credit the income received in advance of how much? Of 800. We put that 800 here. Then the description we're going to write here, when we credited income received in advance, what did we debit? We debited rent income. The reason I keep on emphasizing here that when you credited income received in advance, what is it that you debited? The one that you're going to write here, which is rent income, is that we've seen students, they will just say income received in advance is credited by income received in advance, which is incorrect. Income received in advance will be credited by what was debited. What did we debit? We debited rent income. Then let's go now. You are required to disclose or to show in the statement of profit or loss and in your statement of financial position. So we know that income and expenses go to your statement of profit or loss. So here we are dealing with rent income. So rent income, we've received how much? 10,400. We are saying minus what? 800. Why are we minusing 800? 800 does not belong into the current financial period. It belongs to the next financial period. So that's why we are deducting it. We're saying minus this 800. We are left with 9,600. This is the same 9,600 that we have transferred to a profit or loss account. This is where we are. This 9,600. Then what happens with your statement of financial position for the year end at 28 February 20.1. We said income received in advance, it's a liability. So we're going to show it as part of your current liabilities. We show it separately as income received in advance. How much is it? It is 800. This is the 800 that belongs to the next financial period. Remember earlier I said when we deduct the income and expenses that do not belong to the current financial period, we subtract them from the income and expenses of the current financial period, and we classify them as part of asset or liabilities in the statement of financial position. Let's move to accrued income. Accrued income refers to income that has been earned in the current financial period, but which has not yet been received. So we have sold something to maybe to a debtor on credit, but they haven't paid us. So which means we've delivered the goods that they needed from us, and then we've done everything. So we have earned that money, but we haven't received it. So we have earned it when in the current financial period, which means it has to be part of the income in the current financial period. Of course, we've earned it now, although we have not yet even received that money. So when you talk about accrued income, it is an asset because they owe us. Those people, those customers or debtors, they owe us that money. It's ours. So it belongs to us. So that's why it's an accrued income. It's an asset for us as a business. So we know asset increases on the debit side, reduces on the credit side. Let's go through an example. On 28 February 20.1, it's the end of the current financial year of Xaxa Dealers. Commission income account shows an income of 2,200. On closer examination, it is established that an amount of 200 earned in commission has not yet been received. So already we know now that, oh, this 200 is our accrued income. And accrued income, we know it's an asset. Assets increase on which side? On the debit side, they reduce on the credit side. So you are required here to show which account you're going to debit and which account you're going to credit for the commission income that has not yet been received. So this is an adjusting journal entry at year end that we are looking for here. And B, disclose the commission income and accrued income in the financial statement for the year ended 28 February 20.1. So the first one that we are trying to do is that which account will be debited and credited for the commission income that has not yet been received. So we know that we haven't received it, but we were told we have earned it. Here on a closer examination, it is established that an amount of 200 earned in commission income has not yet been received. So that 2,200 exclude this 200, but we want this 200 to be part of that 2,200. So which means what we need to do here, we need to credit what? Commission income. Because we know income increases on which side? On the credit side. So we want this 200 to be part of that 2,200. So it's a commission income, it's increased on which side? On the credit side. Let's put 200 on the credit side. And what are we going to debit here? We're going to debit what? Our accrued income. Accrued income, we said it's an asset. Asset increase on which side? On the debit side, because now we are owed that commission income. So which means our asset should go up. And our asset, how do they go up? On which side? On the debit side. So we're debiting the accrued income, which is an asset of how much? Of 200. We have done the adjustment for year end then on commission income. Then I'll also want to show you if you are required to post this to the general ledger account. Commission income, we said income increase on the credit side. So which means income will have the amount need to be on the credit side. So the opening one, what we are opening with 2,200, it should appear on the credit side. Sorry. So already here we have a debt balance that we have brought down of how much? Of 2,200. And then when we read here, when we see this year-end adjustment that we have done here, we said commission income should also be credited by 200. We go to the credit side then of the commission income. We credit that 200. And what do we write here is a description accrued income. So when we credited commission income, we debited what? Accrued income. So you can see already that the credit side is 2,400, but there's nothing on the debit side. So, but both sides need to equal to 2,400. Notice here, we always take the side of a higher figure or amount. We'll make sure that both sides equal to that figure. That's why we are taking how much? This 2,400. And we have 2,400 on this side. So we know that it's an income account. I've said it earlier that income and expenses, we close them off to where? Profit or loss account. We need to have 2,400 here. We close it off to profit or loss account. Then we move to accrued income. Accrued income on our journal end, what did we say? We said debit accrued income of how much? Of 200. Credit commission income of how much? 200. So because now we are dealing with the accrued income account, we go to the debit side, we put how much? 200. When we debited accrued income, what did we credit? We credited commission income. That's how you post. That's why I would like to encourage you that when you're doing your preparation or you're practicing, each and every transaction that you are dealing with, try to see what were you going to debit first and what were you going to credit. Because it helps you when you come to prepare your general ledger account, and it's easier for you to understand the accounting equation when you know now, okay, what is it that I'm going to debit and what is it that you're going to credit. Let's move to B, we were required then to disclose the commission income and accrued income into the financial statement for the year ended 28 February 20.1. Statement of profit and loss. We said income and expenses are recorded here. So we have what here? Commission income. We were already, commission income that we have received was how much? 2,200. We add that one of 200 because we have earned it, but we have not yet received it. So it belongs to the current financial year. That's why we are adding that commission income of how much? Of 200. Then we end up with 2,400. Then for the other part of accrued income, we go to the statement of financial position. Remember, because we said statement of financial position, we only record asset, equity, and liabilities. But on our previous journal entry that we wrote here, we said debit accrued income, which is an asset of 200. Then we go to the statement of financial position. Under current asset, accrued income will form part of your trade and other receivables. That's why we include that 200 here. So this trade and other receivable includes what? Accrued income. Because we said accrued income, it's an asset and it's a current asset. Let's also deal with what? Credit losses. Credit losses. Credit losses, we are talking about the debts to be written off as they are irrecoverable. Sometimes you sell to your customers or your debtors on credit. When you sell on credit, you expect them to pay, but sometimes they go through financial problems, or they are insolvent, or they are bankrupt. They can't even pay anymore. They can't pay what they owe you. So those debts, then what we need to do, they need to be written off. Once we know for a fact that they can't pay it, if they're bankrupt or they're insolvent, that debt is irrecoverable. We can't recover it from them. So it needs to be written off. So we call it what? It's a credit losses. Credit losses and expenses, we treat them the same. So which means your losses, expenses, they will increase on the debit side, they reduce on the credit side. Here, what we have is that on 25th January 20.1, Qaqaqa Dealers received a notification that a debtor, so this is a customer that owes Qaqaqa Dealers money, a Taco, is insolvent. On a closer investigation, it is established that the debtor still owes Qaqaqa Dealers 200 debt. Already that we know that he's insolvent, so he won't be able to pay us at all. So but they owed Qaqaqa Dealers how much? 200 debt. So what we need then, we need to make an adjustment for that so that we have a fair presentation of our debtors or people that owe us a business. This one is a fact, they can't pay, they won't be able to pay. So what we need to do is to write off that debt. Remember this debt, when we write them off, we call them what? Credit losses. The old term was bad debt, but now the term that we need to use is called credit losses. So required. Which account will be debited and credited for credit losses for the year ended 28 February 20.1 and disclose the credit losses in the financial statement for the year ended 28 February 20.1. So here they're saying which account will be debited and credited for credit losses for the year. So we said credit we said losses and expenses, they behave the same. They increase on which side? On the debit side, they reduce on the credit side. So what we're going to do here, we need to debit the credit losses. Like as an our expense, we debit the credit losses. Remember that these expenses increases on the debit side. So which means when a particular debtor is unable to pay us, when we write off that amount that they owe us, it increasing those credit losses on which side? On the debit side, just like as your expenses. So we debit that 230. What are we going to credit then? We are crediting what? A Tango, which is our debtors account. It needs to be credited. And what? And your trade receivable control account and assets. Remember, when you sell something on credit, I think we've covered it on Learning Unit 5. When you sell something to your customers on credit, what are you gonna debit here? Then you debit your trade receivables, or you debit that debtors account because it's an asset for you. They owe you that money. And then what do you credit? You credit maybe your sales, sales that you have made. So now when that debtor is unable to pay now. So initially, remember that initially we've debited their account, but now they can't pay. We need to credit that account. We need to reduce it. Why are we reducing it on the credit side? Because we know that debtors account is an asset for the business, and we know asset decreases on which side? On the credit side. That's why we're saying a Tango or trade receivable control, it's an asset, it's reducing on the credit side. And what do we debit? The credit losses. Then if you were required to prepare a general ledger account for credit losses, already you can see here on A that we said debit credit losses. You'll have debited the credit losses of how much? Of 230. When you debited the credit losses, what did you credit? You credited a tango or trade receivable controlled. For how much? For 230, because it's a credit loss. Remember, I said income and expenses. Your credit losses form part of your expenses. We close them off to where? To your profit or loss account. Then you put 230 on the side. Then this account, there is no balance carried down. It's off. It's sitting at 0 right now. It has been zeroed out. Then you are also required under B to disclose the credit losses in the financial statement for the year ended 28 February 20.1. Start with statement of profit and loss. Remember, this is a statement of profit or loss. So here, income, expenses, and losses are reported here. So we record what? Credit losses as expenses. How much is it? We record that 230. Then we go to the statement of financial position. Under current assets for trade and other receivables, your credit losses. Remember this journal entry that we wrote here. We said debit the credit losses, and what did we credit? We credited your A tangos account and your trade receivable control. So when you come here, trade and other receivables, that's why we're saying sometimes you'll be given a figure for trade and other receivable. Remember they say it was 300,000 for trade and other receivables. That's what we could have written here. But because of that transaction, we know the of credit losses, we need to reduce that account by how much? By 230, because we know out of these trade and other receivable, we know for a fact now that we will not recover this 230. So let's take it out. That's why we minus that 230 here. Yeah. Let me then move to depreciation. So depreciation we are talking about, it refers to what? A systematic allocation of the cost of a tangible or physical asset over its useful life. Depreciation, it is an expense for the business. Let's say, for example, in business, you go and buy a delivery van for 50,000 rand. Delivery van, you are not selling it. You are using to do what? To deliver whatever goods that you are selling. Remember, as you are using this delivery van, it's gonna lose the value. Each and every year you are using it, its value is decreasing. Let's assume that the useful life of this delivery van, it's 5 years, and you bought it for 50,000. It means every year it's going to be losing the value of about 10,000 rand. That's what we are referring to as a depreciation, to acknowledge that this delivery van is losing value each and every year over its useful life. If its useful life is 5 years, it's going to be losing 10,000 each and every year. And depreciation, it is an expense for the business. So we know that expenses increases on which side? On the debit side, and they decrease on the credit side. So this definition here is just saying it's a systematic allocation of the cost. There's a possibility that you bought that delivery van for 50,000, and now here they're saying it's a systematic allocation of cost over each useful life. If you're going to use it for 5 years, so you know that each and every year it's 10,000 rand. So don't just complicate, keep it as simple that depreciation, we are acknowledging that the delivery van is losing value as we keep on using it over its useful life. So key thing here, depreciation, it's an expense. Let's go to an example then. Here, Bakla dealers bought machinery to a value of 80,000 during the year. On 28 February 20.1, which is the end of the financial year, an amount of 12,000 has to be written off as a depreciation. And you are required here to indicate which account will be debited and which account for the depreciation for the year ended 28 February 20.1 will be credited. And you also need to disclose the depreciation expense in the financial statement. Which account will be debited and credited for the depreciation for the year ended 28 February 20.1. So we were told here that 12,000 has to be written off as a depreciation. So which means our depreciation is increasing by how much? By 12,000. Depreciation, it's an expense. Expense is increased on which side? On the debit side. So you debit the depreciation expense of how much? Of 12,000. And what are you going to credit? Each and every time you recognize or record the depreciation, you will also have to address what? The accumulated depreciation. Accumulated depreciation is what? We call it a negative asset, or it's a contra asset account. So instead of us going straight to this 80,000 Rand account for this machinery, what we'll rather do, so that because accounting requires you to keep the historic cost of that asset. So to keep the historic cost, you'll have to keep this 80,000 as it is until we reach a point where we want to sell it, if we don't want to use it anymore. So then to recognize that this asset has lost value, where are we going to keep that, the record of all the value that it has lost over the years, which is depreciation? We're going to keep it in a accumulated depreciation account. So each time you debit the depreciation expense, you have to credit what? The accumulated depreciation, which is a negative asset to a contra asset. What do I mean by that? We said asset increases on the debit side, they reduce on the credit side, but a negative asset will increase on the credit side and it will reduce on the debit side. So as we are crediting the accumulated depreciation, we are increasing it, because it's a negative asset. It's going to behave the opposite way of the normal asset behave, because a normal asset, we say it increases on the debit side, it reduces on the credit side, but a negative asset or a contra asset will increase on the credit side and reduce on the debit side. So accumulated depreciation will be credited by how much? By 12,000. If you were required to do what? The general ledger account for depreciation and accumulated depreciation, you'll have said depreciation, that general entry we wrote, we said depreciation was debited. We go to the debit side here of the depreciation expense, we put that 12,000. And when we debited the depreciation expense, what did we credit? We credited the accumulated depreciation. Because we said income and expenses, we close them off to your profit or loss account. You can see that the debit side is more because it has 12,000 and there was nothing on the credit side. So we take the figure of the higher side. So both sides must be equal to 12,000. But this 12,000 will come, we are closing it off to where? To your profit or loss account. Then it is closed off. Then we move to your accumulated depreciation. When we debited depreciation expense, we credited what? The accumulated depreciation. So we go to the credit side of the accumulated depreciation account. We put that 12,000 Rand and the description here. When we credited accumulated depreciation, we debited what? We debited the depreciation expense. We write that here. It is very important also to know which account you are dealing with so that you don't get confused. If they're asking for accumulated depreciation, just check your journal entries. What did you debit and what did you credit, so that you post accordingly. The reason I keep on emphasizing that, I don't want you to cram things, because you will see when you start doing property, plant and equipment, things will change and you need to be able to understand what needs to be done at what time. Okay, let me then move to B. You were required to disclose the depreciation expense in the financial statement for the year ended. So we know depreciation is an expense. It's going to be reported where? In the statement of profit and loss and other comprehensive income for the year ended 28 February 20.1. So we put our depreciation expense. How much is it? It is 12,000. Then on the statement of financial position for the year ended, 28 February 20.1, we have what? Under asset we'll have non-current asset. Non-current asset, just to simplify it, when we talk about non-current asset, we're talking about those assets that a business that they have bought and they're going to use in the business to support their operation for a very long period of time. For example, when you buy a delivery van that you're going to use for the next 5 years, that is your non-current asset. we're going to use it over those for more than a year. So it's going to be there for 5 years. It becomes your non-current asset. But don't worry about this at this time. When you do property plan and equipment, I will show you why we do it, define it like that. When we deal then with then under non-current asset, we're going to include what? Property, plant, and equipment. Here they bought what? Machinery. Machinery will form part of this property, plant, and equipment. They bought it for how much? For 80,000. Then we are minusing here. What are we minusing here? We are not minusing the depreciation. We are minusing the accumulated depreciation, so that we are left with 68,000. Remember, I said accumulated depreciation is a negative asset, so it needs to be subtracted from this cost of 80,000, so that we are left with a carrying amount of 68,000. The reason I'm emphasizing here is that we are not deducting depreciation here, we are deducting the accumulated depreciation. Sometimes you will find that there is already an accumulated depreciation at the beginning of the year. Now you process the depreciation for the current year. So if you just want to take the depreciation for the current year and you just subtract it here, you are likely to get an incorrect carrying amount. So that's why I'm saying you will say cost, which is 80,000 less accumulated depreciation. At the end of the year, you get 68,000, which is your carrying amount. Those are the class examples that I wanted us to go through. The year-end adjustment that I wanted us to go through at this level. Some will be addressing other topics. Let's say, for example, when we're dealing with your trade and other receivables control account, you will see which one we're gonna be doing at that stage. But now this is the revision exercise 6.1. I hope I'll be able to just cover this because it's not a lot. Yes, so let's hope the remaining 25 minutes will be able to finish this. So this is the revision exercise 6.5. It is there on, if you go to Moodle under our module, you will find this one under your learning unit 6. So here you are given what? The following information relates to A Abu balances at 30 June 20.2. This is an extract. We have rental income of how much? Of 6,600. We have stationery on the debit side of 350. We have water and electricity of how much? Of 1.8. We have commission income on the credit side of 5.6. We have credit losses on the debit side of 280. We have accumulated depreciation on machinery on the credit side of how much? Of 30,000. We have trade receivable control of 11,150. And we also have machinery at cost of how much? Of 200,000. Additional information, which means this extract is coming from what? From a pre-adjustment trial balance before considering the additional information. Now we have additional information. Under A, you are told that only 11 months rental was received. Rent income is how much there? What you see here, there it's 6,600. So they are telling you here it was only for 11 months. But we know that a financial period is made up of how many? Of 12 months. So there is one that is outstanding that we have not yet received. What do we call that one that is outstanding? It is our accrued income. They still owe us that rental income. So we'll determine it very shortly. B, stationery on hand at 30 June 20.2 amounted to 50 rand. So if you check stationery on this extract, we bought a stationery of 350, but we were left with the one of 50. So we know now, if we want to determine how much have we consumed, we know that we have consumed only 300, but we'll show you as we proceed. Under C, 600 commission was received in advance. So we have here a commission income of how much? Of 5,600. They are telling you that this 5,600 includes the 600 that was received in advance. So meaning this 600 does not belong into the current financial period. It's therefore what are we going to do? We're going to take it out. Then under D, an additional amount of 150 must be written off as irrecoverable. We know this is a credit loss that we need to recognize. the credit losses that we have here of 280 does not include this one of 150 because they're saying an additional amount of 150 must be written off. It has not yet been written off. We need to write it off. Then on E, provision must be made for the depreciation of 30,000 on machinery. So we also need to account for the depreciation of 30,000 on machinery. So let me just move. What is required out of this exercise? You will see under revision exercise 6.5 in your on your learning unit 6. It has different requirements than the one that I listed here. These ones, I did it intentionally to only ask for this one so that we only focus on adjustment that I want you guys to pay attention to today. So what is required here is that prepare the adjusting journal entries for the year ended 30 June 20.2, and number 2, show necessary items in the financial statements for the year ended 30 June 20.2. Let's start with the first one. Prepare the adjusting journal entry for the year ended 30 June 20.2. You were told under A that only 11 months rental was received. So to find out how much rent per month it is, you will say 6,600 divided by 11. Then you get that, oh, it's 600 rand per month. And you were told that only 11 months. So which means the financial period is made up of 12 months. So we are owed how much? 1 month is outstanding. So what are we going to do? We're going to credit that rent income of 600, and what are we going to debit? It is the accrued income of how much? Of 600. Remember, this rental income is owed to us as a business, and it belongs to the current financial year, and we have earned it. So which means we need to increase our rent income by 600. And when we increase our rent income, what are we going to debit? Our accrued income. It's an asset. Asset increases on the debit side. Let's move to number 2. B, stationery on hand 30 June 20.2 amounted to 50 rand. It is the one that is on hand. The stationery that was purchased during the year amounted to 350. Remember, when you purchased the stationery, what did we debit? What did we do? We said debit stationery expense. We credited the bank of how much? Of 350. Now we are being told that the stationery on hand at 30 June amounted to 50, which means it was never used in the current financial period. What do we need to do then? We need to credit the stationery expense of 50 rand. And what are we going to debit? We're going to debit consumable inventory on hand, which is becoming our asset. So that 50 rand is becoming an asset now. We are removing it from an expense to an asset because we never used it this year, although we've purchased it, but we did not use it. Then we go to C. Under additional information C, we said 600 commission was received in advance. If you check the pre-trial balance that was given there, commission income amounted to 5,600. What does it mean then? It means this 5,600 includes 600 that was received in advance. So when you receive something in advance, it has been received for a future financial period, so which means it needs to be taken out. So when we received this 5,600, we debited the bank. We credited what? The commission income, because the money was coming in to the business. We debit the bank. It's an asset. Increases on the debit side. We credited what? We credited the commission income. Income increases on the credit side. By how much? By 5,600. Since we credited that commission income, and you are told now that 600 of this commission income belongs to the next financial period, we need to reduce that commission income. How are we going to reduce it? By debiting the commission income of how much? Of 600. And what are we going to credit? Income received in advance. And we know that income received in advance is what? It is a liability of how much? Of 600. That 600 of commission income that we have received, we have not yet earned it. So whoever paid us, they can still demand it. That's why it is a liability for us. That's why we post here 600. And D, an additional amount of 150 must be written off as irrecoverable. So here we are dealing with what? With a credit loss. We know that we're not going to recover this 150, so we need to write it off. The trial balance recorded a credit loss of 280. So already there was another credit loss that had been recorded of 280. But now they're saying an additional 150 must be written off. So how do we do that? We're going to debit your credit losses, which is then expense of how much? Of 150. What are you going to credit? The trade receivable control account, which is an asset. So that debtors account is being reduced by how much now? By 150. Because we know that debtors account is an asset for a business. Assets increase on the debit and they reduce on the credit. So if we want to reduce, we need to credit that trade receivable control account. By how much? By 150. On E, they said, I think here what did not reflect correctly, there was F here, but I'll show you what's that. Then here under E, provision must be made for depreciation of 30,000 on machinery. But under the pre-adjustment trial balance, the accumulated depreciation was already how much? 30,000 that was shown there. But here what you need to do, because they are saying provision must be made for the depreciation of 30,000 on machinery, you're gonna debit your depreciation expense. And what are you crediting? Your accumulated depreciation of how much? Of 30,000. You put 30,000 on the debit, you put 30,000 on the credit. This one was just straightforward. They told you what was your depreciation expense. And then we know when you debit the depreciation expense, you always have to credit your accumulated depreciation, which is a negative asset, which increases on the credit side and reduces on the debit side. Under F, what did not show on that's required? I think there were 6 items. Maybe it's because it's just hidden there. Was that on? They are saying here June's 22's water and electricity account of 160 has not yet been paid, but in the pre-adjustment trial balance, they show you that the water and electricity amounted to 1,800. So that's 1,800. They're showing the one that was paid, and the 160 was not yet paid. So, which means it won't reflect on the pre-adjustment trial balance. So what we need to do then, we need to increase that 1,800 by how much? By 160, because this is June 22. It belongs to the current financial period. So we have incurred this water and electricity expense. So what we need to do then, we're going to debit the water and electricity expense of how much? Of 160. And then what are we going to credit? We're going to credit our accrued expense. Once it's an accrued expense, we have incurred this expense for the month of June, which falls into the current financial year, but we have not yet paid for it. So then we need to credit what? Our accrued expense, which is a liability. We still owe that, and liabilities increases on which side? On the credit side. By how much? By 160. So those were the adjusting journal entries, or those were your year-end adjustment that you needed to perform on this exercise. So, and B, the last part of it, you are required to show the necessary items in the financial statement for the year ended 30 June. So we prepare the statement of profit or loss and other comprehensive income. You will remember that on this statement, we only record what? Income and expenses. And your losses will be part of this. So rent income, you were told that the rent income that was received was how much? 6,600. Let me just go back. So let's show you. And they told you it was received 6,600, and then under A, they said only 11 months rent was received. So we needed to account for the last one. On this adjustment here, we said credit the rent income. So which means income is increasing. You go to say 6,600 plus 600, because we are saying it has to be increased by that 1 month. 600. So then you end up with 7.2. Commission income. Commission income, you were given 5,600, and you were told that 600 was received in advance. So which means it does not belong into the current financial period. We have to deduct it. We did an adjustment journal entry here where we said debit the commission income and credit what? The income received in advance. So commission income was debited, which means If you debit income, you are reducing income. That's why here we are saying minus 600. We end up with 5,000. Stationary expense, you were told that they purchased 350. Now, the one that is on hand that has not been used, how much? It's 50. That's why we are minusing, because here what we're trying to record in this statement is to record the stationery that was consumed during the current financial period. It was only 300. 50 was still on hand. That's why we are minusing it here. Credit losses, you were given that the one that has already been recorded into the credits into the credit losses account was only 280, and they required you to process an additional one. Losses, they behave like expenses, they increase on the debit. So we debited the credit loss of 150. So which means we have to come here and we add. So we'll say 280 plus 150, you get that 430. Depreciation expense was straightforward. You just depreciation expense of how much? Of 30,000. You just subtract there. Notice one thing here. When I was talking about rent income and commission income, you will see here at the end, I did not put this one under bracket. But when I'm going down here on the expenses, I'm showing that we subtract the expenses. This bracket, so we're going to subtract the expenses eventually. So the last one was water and electricity. You were told that water and electricity account showed us 1.8 and we needed to account for 160. So here we said debit water and electricity expense of 150. So when you debit an expense, you are increasing expenses, which means we need to add that 160 here. Then you get what? You end up with 1,960. This is how your statement of profit. These are the necessary items that we needed to deal with when we're doing those at year-end adjustment. Then let's move to the statement of financial position. Statement of financial position, we're going to start here with what our non-current assets. Because statement of financial position, we talk about asset, equity, and liabilities. So here we start with non-current asset, which is property, plant, and equipment. You were told here that the machinery, sorry to go back, the machinery cost was how much? 200,000. The accumulated depreciation opening balance that we already had was how much? 30,000. So let's go down and do the property, plant, and equipment. So under property, plant, and equipment, we say 200,000 less what? 60,000. What is this 60,000? It is the accumulated depreciation at the beginning of the year that we already had, which was 30,000, and then when we recorded the current year depreciation, we credited the accumulated depreciation of how much? Of 30. So when you combine those two, you have a total accumulated depreciation at the end of current year of 60,000. So you'll have said 200 less 60,000, you'll be left with 140. Because here we are saying when you're calculating the property, plant, and equipment here, it should be sitting at your carrying amount. How do you calculate carrying amount? We say cost less accumulated depreciation, then you get your carrying amount. Then we move to current assets. Under current asset, we have inventories, we have trade and other receivables, and we also have prepayments. But under inventories, what are we going to include there? We're going to include consumable inventory on hand, which relates to that stationery of what? Of 50. We're going to add it here. We add that 50. And under trade and other receivables, let's go back a bit. Trade and other receivables, you were told here that trade receivable control is how much? It's 11,150. So then you come here, you say, you put that 11,150, and we also need to add what? We are adding what? 600. Where did we get this 600 from? This 600 is coming from what? Accrued income. Remember, we said accrued income, it's going to be disclosed as part of your trade and other receivable. That's why we are adding that 600 so that the assets are increasing. And here we are subtracting what? 150. Where is this 150 coming from? It is our, I want to show you, it is our When we debited the credit losses, we credited the trade receivable control, which is an asset account. And when you credit an asset account, you are reducing that asset account. So that's why when you go that side, we are subtracting this 150. Someone might be asking, why then did we subtract the whole, why did we subtract this 208? Remember, this 208 of a credit loss has already been deducted from that trade receivable control account. What we are accounting for is what was never deducted from that. That's why we are deducting only 150. Prepayment, talk about prepaid expenses. Unfortunately, on this example, we did not have prepaid expenses. Okay. Then we move to current liabilities. What goes under current liabilities? We have trade and other payables. Here we are adding what? 160. Remember, where is this 160 coming from? It's coming here from when we debited water and electricity expense. We credited what? Accrued expense. Accrued expense, it is a liability. And we said accrued expense will form part of your trade and other payables. Sorry, then that's why we're adding this 160. The last one we have what? Income received in advance. Income received in advance, which we said earlier, it is a liability. If you check under C here, we said debit commission income of 600. We credited what? Income received in advance of how much? Of 600. So we go there and include income received in advance. Here we add that 600. Remember that income received in advance will be shown separately. So that's what I needed to cover with you guys, and I'm only left now with 5 minutes, then it's gonna shut down. Guys, if you want to watch this recording, the same link that we used to join today, you can just simply go and click on it. It will show you the recording that we have done today. So you don't have to wait for me, maybe for Monday to upload. So just go to the same link that you used to join here, and then you'll be fine to watch the recording. And this is the end. Thank you so much. And I hope my colleagues were attending to your question, or even if they did not, if there are some that are left, we will address them. You will be able to see them when you see the recording. Thank you so much. I think we can close the session then, Dion.
Do that.